Hey everyone, welcome back to Corporate Decoder. Today NextNav Inc. just filed an 8K announcing a redemption of its public warrants, and I am seeing a clear signal for existing warrant holders. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing tells us that management plans to wipe out a specific type of shareholder, and we need to understand why and what it means for the stock. So, NextNav Incorporated, a company that is traded on the NASDAQ, has announced they are calling back all of their public warrants. Think of warrants like options that give you the right to buy the company's stock at a certain price. Public warrants means they are held by regular investors, not necessarily big institutions or company insiders. The company is using a specific agreement called the Warrant Agreement to do this. They've set a date, the 26th of June 2026, as the redemption date. After this date, any public warrants not exercised will be automatically bought back. This whole process is essentially the company forcing warrant holders to either use their right to buy stock now or lose out entirely. The price they are offering to redeem or buy back each warrant is very small, just $0.01. This is a pretty common tactic. Companies often do this when a warrant's exercise price is significantly higher than the current stock price, making it unlikely that warrants will be exercised naturally. By forcing a redemption at a low price, they clean up their capital structure and remove potential future dilution from the stock. It is important to note that this redemption likely does not apply to all warrants. The filing mentions private placement warrants are not subject to this redemption. These are typically warrants sold directly to founders, early investors, or other strategic partners, and they usually have different terms. So, if you are a regular investor holding these public warrants, you need to pay close attention. It's crucial to check the terms of your specific warrants to understand if they are part of this redemption. The core of this move is about NextNav Inc. wanting to streamline its financial obligations. When a company has many outstanding warrants, it represents potential future shares that could dilute the ownership of current shareholders. By redeeming these warrants, NextNav is getting rid of that future dilution risk and simplifying its financial landscape. It is a way for them to say, we're getting our house in order. NextNav's common stock trades under the ticker symbol NN, and their warrants trade under NNVW, both on the NASDAQ capital market. This filing gives us a glimpse into how management is actively managing its balance sheet and shareholder structure. It is a proactive step, likely designed to benefit common stockholders by removing potential selling pressure from warrants that might otherwise expire worthless or be exercised at a deep discount in the future. It is worth noting that NextNav is identifying itself as an emerging growth company. This classification often means they are subject to less stringent regulatory requirements, but it also highlights their stage of development. For investors, understanding this context is key to assessing the company's growth trajectory and financial strategy. The key takeaway here is that NextNav is giving warrant holders a choice. They can exercise their warrants to buy shares of common stock at $11.5 per S-share before the redemption date of the 26th of June 2026, or they can have their warrants redeemed for just $0.01 each. The decision for warrant holders hinges on whether they believe NextNav's stock price will rise above $11.5 before that date. If they think it will, exercising the warrant makes sense. If they don't, they will likely see a massive loss on their warrant investment, as the $0.01 redemption price is essentially giving them almost nothing back. Think about it this way. If you have a warrant that lets you buy something for $11.5, but it is currently only worth $5 in the market, you wouldn't exercise it. Instead, in this scenario, the company is forcing you to sell it back for pennies. This action is also usually accompanied by a press release, which we can see is filed as Exhibit 99.2. This kind of redemption event can sometimes put pressure on the stock price in the short term leading up to the redemption date. Warrant holders who are trying to avoid losing their entire investment might sell their warrants at whatever price they can get before the deadline, or they might exercise them if they have a strong conviction that the stock will exceed the exercise price. Looking at the broader context, NextNav is in the business of providing location technology. Companies in this space are often looking to strengthen their financial position to fund growth, research and development, and expand market share. This warrant redemption is a typical part of that process, allowing them to move forward with a cleaner balance sheet. The filing is signed by Timothy A. Gray, the Chief Financial Officer, indicating this is a strategic financial decision being executed at the highest levels of the company. It is a clear signal from management that they are focused on optimizing the company's capital structure. What I'm really watching here is how the market reacts to this warrant redemption. For the common stockholders, this is generally a positive event as it removes potential future dilution. However, for the public warrant holders, it is a stark reminder of the risks associated with warrants, especially when they are out of the money. Historically, When companies initiate warrant redemptions like this, especially for smaller companies, it often signals a confidence that the stock price will not reach the exercise price in the near term, or that management wants to eliminate that potential future overhang. A similar situation with some SPAC warrants in recent years has seen holders receive very little, in some cases effectively losing their entire investment if they did not exercise. My biggest concern is the potential for uninformed warrant holders to simply let their warrants expire or be redeemed for a pittance. The opportunity for profit is gone if you don't act. The risk I am watching is whether the common stock can sustain a price above $11.5 in the future, which would have made these warrants much more valuable. What I'm actually looking for is how management plans to leverage this cleaner cap table to drive future growth. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. We also have a Discord community linked in the description below.